Welcome to the Commonwealth Parliamentary Association rooms. Welcome to the breakfast. My name's David Hanson. I'm a Labour Member of Parliament from the United Kingdom. And we're here today to discuss modernising international tax rules. And today's session will last till about 9:15. I'm chairing the first half. I have to leave for another meeting, and my colleague Ian Littlegranger will be chairing the second half of the breakfast. Today's breakfast, just for information, is being filmed and being audio recorded, and the details of that will be on the Commonwealth Parliamentary Association's website within the next 6 to 7 days if you want to refer back to what our speakers are saying. Today we did have two advertised speakers. Unfortunately they're ill, but with great prescience we've got Joseph Stead from the OECD, who has stood in to help support the breakfast today, and Joseph will be giving a presentation very shortly. As you know, tax affairs and international tax are very high on the agenda throughout the world at the moment, and here in the United Kingdom we're no different than your own countries, in the sense that we want to look at very much how we can engage with transparency, how we can make sure that multinational companies pay their taxes in the appropriate country of best serving with the tax regime. We want to look at a range of issues, and we're looking now currently at how we can have a public inquiry into tax affairs, how we can look at specialist tax enforcement, how we can look at, even whilst we're still in the European Union, working with our European Union colleagues to get a European Union-wide approach to this. And we're looking also at how we can crack down on some of the accounting tricks and accounting policies that are allowing some companies to exploit tax rules not to pay tax. This is important to us in the United Kingdom because we obviously want to maximise our tax revenues, but equally it's extremely important in all countries of the world, particularly where we have multinational companies based in countries where they're not paying tax in the United Kingdom or in other European countries or American countries, and they're not paying tax in African or Asian countries either. And those tax complexities are ones that we have to address very carefully and very speedily. And we're very keen in the United Kingdom to work with partners across the world to look at how we can do that. Today, as I've said, we've got Joseph Stead, who's Senior Policy Advisor in the Tax and Development Programme at the OECD, and he will be speaking to us very shortly. He's going to be introducing the framework implementation, which will give the outcomes of the Kyoto meeting that happened last week from the 29th of June to the 1st of July. And we're going to look at those issues in detail. I'm going to stop speaking now because, as you can tell, I'm quite croaky this morning. It's my third day of man flu, and I'm just about, this is my least croaky of the week, but I'm still relatively croaky. So I'm now going to hand over to Joseph Stead, who's going to do a presentation, and then we can take some questions and contributions from the floor. Joseph.
Great, thank you very much. And yes, apologies for not being any of the people who've been billed for this event. You can take it from me, they sound distinctly worse than David, and they really wouldn't have been much use to any of us. And I'm still hoping that I'm not going to be infected by them. So yeah. But if you've got man flu, David, we'll keep our distance from each other here. Anyway, so. What I'd like to talk to you about a bit today is about some of the events that are going on around international tax. Now, I know you're part of a workshop around kind of aid effectiveness, and there's a lot of aid being spent on tax systems, but also the fact that just as much as you want any aid that is being provided to be effective, we also want tax systems to be effective and the money that is raised by taxes to be spent effectively, and there's a huge role for parliamentarians in that. So what I'll try and do today is just kind of talk through a bit in terms of the context of what's going on in international tax, its relationship to development and developing countries especially, what's kind of happened so far, how developing countries have been involved, and then what's happening in the future and where we go from there, and especially around some very recent developments that are very exciting and really are changing the way that international tax is going to work. And throughout that, I'll try and highlight what I think some of the roles for parliamentarians are, but I'll try and sum that up again at the end. Oops. Okay, so first of all, just to give it a little bit of context in terms of why we focus on tax and development at the OECD, and it is that crucial role that taxes or domestic resource mobilisation has in development. It's widely recognised that they are one of the main sources of funds for development, but also in contrast to aid, taxes can be much more reliable, much more sustainable, and also because you have that much greater link to parliamentarians like yourselves, the accountability to the citizens is much more direct with tax systems, and so we see them having a really strong role in terms of accountable governance and making sure that actually they can deliver much more directly to the development needs of the country. There's less the whims of donors are a factor in terms of tax systems. So that's some of and we've seen this kind of focus coming up significantly recently, and we saw in the Addis Ababa action agenda last year around financing for development. Domestic resource mobilisation was a really key issue in that. Again, something seen in the Sustainable Development Goals. And so this recognition that getting tax systems to work for developing countries to provide those resources for development is a huge issue. So that's kind of why taxes matter. So what is going on in the international environment? And a lot of this has been focused around something called BEPS. And BEPS stands for Base Erosion and Profit Shifting. And this is essentially the disconnection between where things actually happen and where the taxes get paid, or in many cases don't get paid. And so it's kind of this grey area, which you can see in the diagram there, where BEPS is generally not illegal actions. It's not but at the same time, it's not explicitly legal. It's not tax planning, which in the UK you have individuals can invest money in something like an ISA. Now, Parliament has said we want to encourage saving. We will exempt some of your savings from tax. There's a limit to how much you can do on that. It's very clear. Everyone knows what the intention was. But there's this grey area of tax avoidance where, strictly speaking, it's probably legal, but it's unclear if parliamentarians passing the laws ever meant to do that. And so it's definitely a grey area, and especially around international tax, where you have different legal systems in different countries that don't quite intermesh properly. There's a huge opportunity to enable effectively double non-taxation. So income is not taxed in one country, it's not taxed in another country, and that's the problem we're talking about. And it means that countries are not able to tax the full range of activities that they would like. So the tax base has been eroded. And you see that companies shift their profits around. So profits that come from economic activity in one country appear on paper in another country. So that's the profit shifting part of it. So to look in terms of the impact of BEPS in developing countries, there's been a few reports done into that. So the G20 asked the Development Working Group in 2014 to put together a report on this, and the OECD kind of led on that and had many regional discussions and consultations with developing countries to find out what the experience of developing countries is around the issue of BEPS and other kind of problems around international tax. And this was put together in a report which is available online, and it found a number of things. It found that some of the things that was happening in the BEPS process, which was the G20 process, Some of those issues were the same for developing countries. There was other issues that were not planning to be addressed by the G20, such as issues around tax incentives, but it was highlighted that those were clearly a problem for developing countries. So the report kind of set out how the G20 can assist developing countries address some of these challenges, and also highlighted the need for developing countries to have a voice in the international discussions that were taking place. You know, these problems around BEPS are caused by national legal systems not meshing up, and if you don't include developing countries in how that's addressed, then you're not going to help developing countries be part of the solution. So it was clear that developing countries needed to have a voice. Some of the key findings that were found out were the lack of legislative measures in many developing countries, and that's clearly obviously a big role for parliamentarians. So there were some domestic actions that were not being taken, and that was partly due to lack of capacity to kind of find the policy mechanisms to develop the laws to say, well, actually, what can we do about this? But also to fully understand, in some cases, how some of these complex structures were working and how the law could respond to that. A lot of issues around lack of information. So there's a big challenge in terms of if you are trying to effectively tax multinationals, the information that you may need to find out what a multinational is up to is not held in your country. So you need to be able to access information from other countries, and developing countries often do not have the legal mechanisms to be able to do that. And then there was the difficulties around just the capacity in many countries, and you see that especially when you have incredibly complicated structures and rules, and developing country tax authorities looking to try and challenge multinationals, and they often have fairly poorly resourced revenue authorities. They call a multinational into an audit, and then suddenly there's a whole room full of very well-paid lawyers with lots of experience, and it can be quite an intimidating environment to be in, and is a big challenge for developing countries to pursue even one case in many cases. But if you have if you're trying to do multiple audits simultaneously, that can be a huge challenge. And so how you build the capacity up in developing countries is a huge challenge. To try and put a bit of kind of numbers on some of this, it's obviously a very difficult thing to estimate, because no companies go around saying, well, this is exactly how much money we're avoiding in a given country. So you have to try and find ways to estimate it. And part of the BEPS process, the OECD has tried to do that. The IMF have also tried to do some of this. And the estimate is that, the very conservative estimate is that globally, somewhere between 100 and 240 billion US dollars is lost to this kind of BEPS kind of action. And that's somewhere between, but other estimates say can kind of go to a slightly higher range of kind of 4 to 10% of global corporate income tax revenues. For developing countries, the impact is likely proportionally significantly higher. Many developing countries have a very heavy reliance on corporate income tax in their tax systems compared to developed countries. Often in places like the UK, corporate income tax is around kind of 3 or 4% of the tax ratio. It's up to kind of like 10, 12% in many developing countries. And you see that in places like Rwanda, 70% of its tax base comes from multinationals. That's obviously not just corporate income tax, it's personal income tax too, but it shows you the level. And if you look at this graph here, it's looking at the revenue from corporate income tax, and the red line on that is the low-income countries, the green line is the lower middle-income countries, and the blue line at the bottom is the high-income countries. So you can see that large disparity that's going on there. So this is why addressing issues around corporate tax avoidance, and especially for multinationals, really matters to developing countries. And I think what we've seen as well is the The reason why this became a big project in the G20 countries was in part because of the role of parliamentarians. You know, you've seen the likes of the Public Accounts Committee in the UK under Margaret Hodge in the last Parliament really pushing this issue and forcing companies to try and explain what's going on, but also forcing governments to be accountable as to why we have tax systems that appear not to work in a way we'd like. We've seen the European Parliament do it. We've seen the US Senate do it. We've also seen the Australian Parliament have been pushing this. And so the reason why this has become such a big issue in G20 countries has in part been because parliamentarians have really pushed the issue. Now, I know this is beginning to happen in some developing countries. I know there was a big session in Africa last week about public accounts committees thinking about how they can do more on this issue. And so I think it's, again, it's a big role for parliamentarians to try and highlight this issue, to try and encourage accountability, both from the companies that are operating, but also in terms of the governments, in terms of how are they addressing this kind of issue. So why the BEPS project? So kind of what's going on here, and why did the G20 decide they really need to do something here? And partly it's because economies have changed quite significantly. We have a much more electronic and a much more global world now, and so that's created many more opportunities to avoid tax. When companies are claiming that most of their profits come from the brand or the marketing or the patent rather than actually the physical act of producing stuff, those kind of intangibles, you can shift them around and pretend they sit somewhere where maybe they don't. And so you can see marketing suddenly appears in a very low tax place, even though there may not be people there doing the marketing. That might all be being done where the big markets are. And so those are some of the problems that created new opportunities to avoid tax. And then there's also the fact that because we have so much international trade and we have a globalized economy, it means that the local laws are increasingly not sufficient to address these issues. So when you suddenly have the estimates are 50 to 60% of world trade takes place within multinationals, you can see how that globalized nature has changed things, and that the laws in one individual country may not be sufficient. There's a need to coordinate what is going on in terms of international laws and rules around tax to make the system work and to reduce those opportunities for companies to avoid tax completely. And so that's what the BEPS process was designed to do. And I think kind of in addition to that, it was also in terms of how do we get back some of the things that we really need to have in a tax system? So issues around kind of trust. How do we get people to actually trust that the tax system is something that they can believe in, and that the tax system is fair? We know from many tax systems that they rely on people being willing to pay tax, and essentially voluntary compliance is very, very important. If people think that the big boys are getting away without paying their fair share, then that filters down through the rest of the system, and others say, well, maybe I won't bother maybe I won't bother paying my tax. I'll look for a way to avoid things. And suddenly you lose trust in the system, and that means that compliance drops off a cliff, and it's very difficult to then bring the revenues in. So those kind of issues around kind of trust and integrity. But there's also issues around economic efficiency as well. It's by having some companies who are able to avoid taxes, it can distort competition, so that cross-border companies may be able to have effectively a lower tax rate than domestic businesses, and that gives them an artificial advantage. So they may not be the best company in classical economic terms, but they've managed to become more competitive because they've managed to reduce their tax take. So that's a huge problem in terms of getting efficient economies. And also kind of issues around distorting investment decisions. So companies may end up choosing to invest in other places because of their ability to shift taxes rather than where is the best place to actually locate. So there's all those kind of issues that kind of come up, and this is why, whereas a lot of times the OECD has been looking at how you can make sure that companies don't get taxed twice in two countries. Now this big focus has been towards how you can make sure that companies are actually paying some tax in places, because we have this issue of double non-taxation. So that was kind of the background to what the G20 started doing, and I'll just quickly try and take you through some of the BEPS outcomes, and I will try and avoid all the technicalities because there's a lot. But I mean, those 15 areas that have been addressed, and they include a number of actions. So the main kind of issues are around exchange of getting kind of better information, and also how we can boost up international treaties to try and bring that coordination. I think one of the things to note is just the huge pace that this has gone on. So it was a 2-year project, and on these 15 actions, there's been over 12,000 pages of comments coming in from various sectors, businesses, NGOs, academia, as well as all the different countries that have been involved. Multiple webcasts and consultations. It's been a huge pace to do all this, and it's been an amazing project to get so much consensus on achieving various things. The main issues I think to focus on are there are 4 minimum standards that have kind of come out of this. One is need to have better coordination and cooperation between countries on identifying and sharing information around harmful tax practices. Another one is around tax treaties, and so making sure that all countries are taking actions to make sure that their treaties cannot be used to avoid tax. Another issue is around kind of information and country-by-country reporting. So the requirement that all multinationals will have to prepare a country-by-country report, so listing their operations in every country where they operate and key financial information about their operations there, and that will be shared between tax authorities. And the final one is a commitment to improve dispute resolution. But as much as a lot of double non-taxation goes on, there is still a problem around sometimes companies will be taxed in 2 countries, and you have to find a way to resolve those disputes when a company is legitimately aggrieved that 2 countries are trying to take the same money off them twice. So that's kind of the core. There's a lot more that's kind of gone on there, but essentially what's happened is you've found some very strong agreement on some new measures like country-by-country reporting. You've found agreement to work towards new standards in some difficult areas. And so you have things like exactly how do you deal with the digital economy and the fact that you have virtual products. 2 years wasn't long enough to find an answer to that, but there's a commitment that that all the countries involved really need to do something better about that. So there's a commitment to work towards new standards there. And then in other areas like dispute resolution, there's an agreement to move closer to finding new standards. So it's been a consensual approach. So there's no standards trying to be forced on anyone. So somewhere there's been clear agreement, let's have a new standard. But some areas like, well, we don't have full agreement, but there's an agreement to try and move closer so that we can harmonise towards things. And accepting it may take a little bit of time to actually get to something that everyone feels comfortable to agree on. So what's been the role of developing countries in this? Over 120 countries, so 122 indeed. Sorry, these weren't my slides, so I'm covering for someone else. So sometimes I'm slightly surprised when the details that I didn't know is in there. 122 countries involved in the process, either directly or indirectly. And what you saw was very quickly after the process was started by the G20, it was realised that because this is such an international issue, you can't just try and keep it within the OECD G20 countries. And so there was a new strategy in terms of how do we get views from other countries in. So lots of regional consultations were held in 2014 and 2015 in partnership with lots of the regional tax organisations, such as CREDAF amongst the Francophone countries, CIAT in the Americas, ATAF in Africa, IOTA in Central and Eastern Europe. And these all fed in to developing country-specific concerns into the BEPS process. You also had another 14 developing countries participated directly in a number of the events, in a number of the workshops with the OECD. So there was a direct feed in there. And so what you have now is so you've had all of those consultations going on, and also outside of the BEPS process, there's also a discussion on how to create a new international treaty to implement some of these actions. And that has 96 countries involved in the negotiations for that. And again, many developing countries are in that, and they're in there in a completely equal footing with exactly equal voting rights and everything else. And that set the standard to where we go now. So it is to look at how we make sure that all countries are involved in an equal footing. So you've seen this statement by the G20 leaders in Antalya last year. So this gave the mandate to the OECD to broaden out their structures to include all interested countries in this, and this has been a very fast moving agenda. So when a lot of the BEPS outcomes were announced in October 2015, we envisaged a more inclusive framework to bring things out, but then the G20 has given the political mandate to go even further of that. So this is a genuine kind of big shift in terms of how the international tax discussions take place. That you will now have as many countries as are interested taking part on an equal footing. There are challenges to that. So how to help make sure that countries coming in are able to meaningfully take part effectively. There are challenges in terms of capacity, in terms of financing, in terms of getting to meetings and everything. So there are kind of things going on there, but there are also positive past experiences in terms of information exchange. There is a global forum on transparency and exchange of information, which has 135 members in it now. That's been broadened out dramatically since the financial crisis. And that's working very well in terms of bringing new members in. And you have a system of peer reviews that take place in that, and that enables other countries to help each other through, identify where kind of challenges may exist, help ensure kind of those issues around implementation and monitoring. And so we're hopeful that we can see similar kind of processes go on this. So essentially we have now all interested countries can join. The requirements to be part of it are that those 4 minimum standards around BEPS, there has to be a commitment to implement them. And that's essentially to show that there is that political commitment amongst the countries to take the kind of actions to stop harmful international tax abuse. So that's why those kind of standards are in. And there is also a variable financial commitment depending on the size of the country. But again, that's partly because running all these meetings costs money, but also by having a financial commitment in there, it's found that helps a political commitment to actually taking part in some of these things. But so that's the requirements to be part of it, and that's what will be, and that's where we're going. So it's called the Inclusive Framework on BEPS, and so it allows all countries and jurisdictions to partake in this on an equal footing in this standard-setting process around these international tax issues called BEPS. So they effectively get brought into the Committee on Fiscal Affairs, which is the OECD's body that worked on these tax issues. So they will be directly part of that institution on all these BEPS issues. So as I said, it really is a big opening up of the situation. So all the BEPS implementation will take place within the Inclusive Framework. It brings in all these non-OECD G20 countries called BEPS Associates. That work is overtaken by a steering group. So it's OECD Bureau members. So that's the name of the body that has been steering the CFA, and then a number of BEPS Associates. So there's 8 countries have been elected onto that, which I'll talk about in a second. And so, yeah, again, it's full access to all the working party meetings and everything. This is a change in how things are done. And so, yeah, so we've had 64 new countries have accepted to join. Some of them are still in the process of sending the letters and everything to do that. And there's definitely a question for parliamentarians to check in terms of if your country is, if your government is looking to be part of this and where they are in that process. But you can see from this chart how things have changed, that you now have the vast majority of countries involved are non-OECD, non-G20 countries here. So it's a big change, and it's more than doubled in size, the Committee for Fiscal Affairs, which is going to have its own challenges in terms of how you make an institution work. But we're going to be working through all of those issues. So the purpose here is, implementing and monitoring those minimum standards. So can we make sure that all countries are really making on this progress? So there will be review mechanisms to look through these things. There'll be follow-up to those standard settings. So do these standards actually work? Are they working for all the countries? If not, what adjustments need to be made? There's a lot of action being taken place on toolkits to help developing countries, especially around some of these issues. So one has already been produced around tax incentives, and so there's follow-up work in terms of how can we help use those toolkits, help developing countries look at their tax incentive regimes and take that forward. There's another 7 toolkits to come, some around how you effectively tax extractive industries. Some get increasingly more complex around the right ways to price the internal transactions that the multinationals take place. So there'll be continuing work with all of those things, which is a very specific kind of focus to really help developing countries. Also be looking at those issues around information and knowledge sharing. So how can you help get information on harmful tax practices? So things that multinationals have been trying to do in OECD countries for many years, they may well be about to start trying in developing countries too. How can we make sure you get information around those kind of aggressive tax avoidance schemes to revenue authorities in developing countries, so that they can take action quickly among them, and also information around those country-by-country reports to make sure that information is flowing, and also how we can bring capacity building through. So again, this will be an area where developing countries will be able to raise the challenges that they face in terms of, well, we'd like to do these actions, but these are the capacity constraints we face. How can we address them? How can we get support to help us do that? So that's kind of the purpose of it. Now, this is literally just happening now. So the first meeting of the Inclusive Framework took place in Kyoto in Japan last week. And so we had more than 80 countries and jurisdictions gathered there. Apparently it was a huge aircraft-like hangar to get everyone in. And there was a dedicated person behind the chair with a pair of binoculars to be able to spot which country's flag was raised, so that everyone made sure that no country was misidentified in any of this. So yeah, apparently an amazing event to see. So you've got 36 new countries have formally joined, and many more have said that they're interested in joining it. You also see the international organisations such as the UN and IMF and also the regional tax bodies like ATAF and SIAT are also kind of associates in this project to make sure that they feed into this. And there is a desire to make sure that this is hearing the view of all stakeholders. So they had representatives from business and civil society. Maybe there's a question for the future in terms of where parliamentarians fit into some of this. So again, this could be something you should maybe be pushing in terms of how do we get parliamentarians to feed into this process. It was a big success to get this far in terms of taking place, but there's been some really good outcomes coming from it. So there is now a clear kind of governance structure. As I said, there's eight new countries kind of coming in to be part of that steering group, including Brazil, China, Georgia, India, Nigeria, Senegal, South Africa, and Singapore, which is not a developing country but has never been part of any of these structures before either. So that group is going to start working and will be, as well as on the implementation, looking on kind of standard setting on some of those remaining issues and transfer pricing, that issues around how companies set their prices in internal trade, and also issues around interest deductibility, which is a big problem for many developing countries in terms of highly leveraged investments in countries, so mostly financed by debt. And so a lot of the profits get wiped out by interest repayments. And so I think there's some really big potential gains for developing countries to see through new standards coming up in some of these areas. But also in terms of that implementation, they'll be developing kind of practical guidance to support the implementation, especially on those 4 standards. And again, this is a really great opportunity for developing countries to be able to highlight what works and what doesn't work on these new standards and to make sure that they're able to benefit. This wouldn't be a proper OECD presentation if we didn't blow our own trumpet a little bit about the role that we play in some of this. So in our tax and development programme, we are involved in the capacity building support, and there's a number of things that we do, and other international organisations and donors play a role in this. And I'd be remiss if I didn't say the excellent work of the CPA as well in terms of playing a role in sharing information and building capacity amongst parliamentarians in terms of their role in these things. But in terms of the OECD, we will try and have multilateral and regional dialogue and consultation so the issues can be identified. We'll then look at how we can build up kind of training programs. So we do trainers events. We also work on kind of bilateral capacity building. So we have in-house trainers who will go and work directly in countries. And then kind of most interestingly, kind of recently we've started doing direct audit support. And I'll just take a minute or so to talk a little bit more about that. And so this is kind of a new piece of work that's kind of come up in the last few years, and we're calling it's called Tax Inspectors Without Borders. And it's a joint initiative with the UNDP. And what it is, it looks to take skilled, experienced tax professionals and allow them to be embedded directly into the revenue authority of developing countries and work on real-time live cases and help kind of solve in a learning by doing approach. And so it's, it can look and cover kind of both indirect and direct taxes. It can work anywhere through the audit process. And what we often find is that there are multiple stages to it. So you will have people come in, they'll help in terms of identify the cases for audit and then come back repeatedly through the process and kind of act as a kind of a mentor throughout a lot of this process. It's been incredibly successful so far. So there's not been a huge number of cases take place with this, but in terms of I think we've had about 20 or so, and we reckon that there's at least an extra $200 million worth of increased revenue has occurred. So I know in Kenya there was an extra $35 million in Kenya, an extra $50 million was managed to be raised in Zimbabwe. In Colombia, they've managed to increase their tax take from transfer pricing audits by 70%. So this is incredibly impactful. And what we've also seen is by having this kind of learning by doing approach is it really can help things kind of carry on. So again, in that Colombia case I mentioned, it wasn't just the one-off case they were working on. It's enabled them to really change their approach around some of their processes around multinational taxation, and it's been able to make them much more efficient and much more effective. So it's a really exciting program that we are looking to expand as much as we can, and and hopefully there will be opportunities for many of your countries to benefit from this. There are kind of challenges and everything in terms of legally, there are some hurdles to jump through in terms of getting a foreigner to come in and work directly on tax cases, and we take those very seriously, and and we're working through how you make sure those things and potential conflicts of interest, for example, making sure that those are addressed. But it's a really exciting program that we think is a good example of what can be done in terms of capacity building. So I've kind of sketched out a lot of things there, and then we need to come back to what's the role of all of you guys in this. And there's some things up here, but I think the summary that I would think of in terms of what the roles of parliamentarians are at the very kind of basic things in terms of is just that accountability on how taxes are being spent. That is one of the key things. The whole point of improving tax collection is so that the taxes can be spent in a way that benefit the citizens of the country and lead to development outcomes. And no one else can do that apart from you guys here in the room. And so that is a huge role for parliamentarians, and that should clearly always be part of it. But then kind of down from that, and say, what is the plan around the tax system in the country? The Addis Ababa Action Agenda says that countries should have a national financing plan about how they're going to meet the Sustainable Development Goals. Now, as part of that, there should also be a plan in terms of how the tax system will feed into that. So, does your country have a revenue strategy that kind of looks in the medium to long term? And if it does, has that been interrogated by Parliament to see if it actually stands up to anything? So again, there's a role for parliamentarians in asking around, well, what is the revenue strategy for the country? How much has Parliament played a role in assessing the tax legislation? And that can be both around the domestic and the international. What's the role for Parliament in terms of assessing the tax incentives that are granted? Are they costed out? Are you able to assess them and repeal ones that are not working? Similarly, in terms of the international tax dimension, how up to date are the laws in your country? Are they fit for purpose? Again, there's a big role for Parliament. If government's not undertaking those reviews, then Parliament can force them to do it. The assessment in terms of what the tax gap is in the country, has that been assessed? What are the biggest risks in terms of the international tax? The Mbeki panel on illicit financial flows from Africa, part of that report suggested looking at what are the biggest risks to the country in terms of illicit financial flows going out, and so that gives a framework there that parliaments can work with to say, well, have we gone through these different risks? Have we assessed them? And if we are at risk of illicit financial flows, what are we doing to bridge those gaps? Getting down to kind of more the specifics in terms of what I've been talking about today as well, is the government involved in the new inclusive framework? Questions can be raised on that. If the government hasn't taken a position on that, then ask questions in terms of why not and what the plan may be. if they have committed, where is the government in terms of meeting some of those minimum standards? And again, what is the strategy around international tax? And also, how is Parliament holding government to account on some of these commitments around international taxation? The OECD CFA and the Inclusive Framework will work a lot through peer reviews and that kind of process. Now, peer reviews are good, but they are not the same as Parliament holding governments accountable. That is the gold standard in terms of the way of holding governments to account to their commitments. So, don't the peer review process that will be led through the Inclusive Framework is kind of the second best option after Parliament having done all of this work before. And ideally, the peer review process through the Inclusive Framework will come and see that the actions have been completed. There is Parliament has been holding government's feet to the fire in terms of reaching all this, and it will be a good, quick, and simple process. So I think there's a big role for parliamentarians to complement kind of those international peer review processes. You are the peers of your governments in the domestic sense, and so that's the primary mechanism that these things should take place in. So those are some of my thoughts in terms of where parliamentarians may fit into the process. But I've never been a parliamentarian, and it's certainly not my intention to ever be one. I think you guys have far too tough a job. I could not do it. So I think I'll maybe kind of draw it to a close. Just to say, in terms of a bit of what's coming up next, is there will be various kind of working party meetings and kind of regional meetings to try and kick off this inclusive framework to the next big meeting held in January 2017, when we hope that all the countries that want to be part of this will be part of it. But as I said, I think I've sketched out some of what I think your role might be, but I'm really interested to hear if I've got that in any way right. And if you have completely different ideas in terms of what your role might be, I'm now at your disposal to help answer any questions that may help you do that. So please, over to you guys.
Well, can I first of all thank you, Joseph, for that comprehensive. I'm sorry I came in slightly late. Just so you know who I am, I'm Ian Littlegranger, the chairman of the CPA UK branch. Good morning to you all, and marvellous to see you all here. Now, from what I've just heard, there's some actually quite challenging questions even I've got. Have we got questions from the floor that we'd like to have? Just, sir, can we just start over there? Okay. Far away. Just coming through. Here we go.
Thank you very much. It was really a very good presentation. I have two questions. One is related in issues we heard last year on multinational companies not paying taxes in Great Britain. Google, Amazon, Starbucks, and probably others. These cases of tax evasion or tax avoidance?
Okay,
I would like to
answer that one.
understand. And what is the present situation? There are improvements or not? The second question is related with the role of parliamentarians in the BEPS. I would like to know if there is a possibility for capacity building, because one of the difficulties you said in terms of BPs, the impact on domestic resource mobilization, you said that there are difficulties in capacity building. And we parliamentarians, in the case of Mozambique, really, there is a big need. How to capacitate parliamentarians? Thank you very much.
Interesting.
I'll take the second question first, whilst I think about the answer to the first one. There definitely is a need for more capacity building for parliamentarians. The challenge sitting in the OECD is the fact that we're not especially well placed to do some of that, and it's unclear we have a mandate to do it. However, I think there is many of the kind of same approaches that are being looked at in terms of capacity building with revenue authorities, ideas of mentoring arrangements, kind of twinning arrangements, and and workshops in terms of actually how do you go about certain actions around the tax area. So much as we're doing training sessions around how do you go about identifying which companies you might want to bring in for an audit. I think you can take the same approach with parliamentarians, so you could have the likes of public accounts committees looking at terms of doing training sessions in terms of, well, this is the way that we go about doing some of this. These are the tools that we have. There's probably challenges because different parliamentary systems are different in terms of the remits of committees and things and how they work, but it's definitely kind of that kind of thing I could see being certainly being done. I think the challenge, I guess, is that all of these things always take money, and it requires donors to look and prioritise some of this, and whether necessarily donor governments are always keen to encourage the growth of parliamentary accountability, I never know, but I think we need to keep kind of making this point, and I think the more the Commonwealth Parliamentary Association can help trying to make that point, and whether there's things we can do in terms of getting kind of joint statements or whatever to the likes of DFID to say, well, look, we have however many parliamentarians from however many countries around the world, and we think this is absolutely a priority to do, and we have the likes of the Addis Tax Initiative, which was announced in the margins of the Addis Financing for Development Summit. 14 of the 15 largest providers of development assistance have pledged to collectively double the amount of spending they provide for tax capacity building. Now, some of that should definitely go towards building the capacity of parliamentarians. So there is a space now to kind of pitch in for some of that money. And I guess the challenge is, which are the institutions that can do some of that? CPA is clearly one. There must be others. And how can they look at getting into doing some of that? So I think it's absolutely support in terms of that's what we need to do. Quite how you do it, sadly, is not where the OECD is best placed. But I'd encourage kind of thought about that. On your first question, on the Google and Amazon, etc. Those things are going on. In Europe, you've had the European Commission has been looking into whether they breach the state aid provisions, and so whether the governments have kind of gone beyond their remit in terms of what they've allowed these companies to do. The fact that they're taking those state aid procedures suggests that it is very much clearly in the avoidance category, because governments appear to have agreed with many of these activities, and the combination of actions that may be taken by the European Commission, and also the BEPS processes that are taking place should begin to kind of reduce the scope for multinationals to engage in some of this. Now, it won't solve all of the problems, and the fact that you have Google and Amazon kind of up there show that question about the digital economy and how do we think about taxing that, still remains a live issue, and 2 years wasn't long enough to come to an answer on that in the BEPS process. So that work continues. So I think it's and again, I think the recognition is the laws aren't, the laws don't fit it yet, which again suggests we're in the avoidance category because the laws just haven't caught up.
I'll tell you what we're going to do. Just before I take the next question, can I have a cup of coffee from the microphone? It's the gentleman at the back in the spectacles. just you. I've got you both pegged. Thank you. That's it. The gentleman there. Thank you, sir. Bless you. Thank you so much.
Thank you, Mr. Chairman. In my previous roles, I've had the privilege of working with the Committee on Finance. And in Nigeria, the Committee on Finance has a humongous task of jurisdiction over the revenue of the country. And I was privy to a number of insights, reports, and so on. And there are so many. But I'd like to share one perspective. And that tallies a lot with what happens within the developing country's framework. The issue has to do with tax culture. And the tax culture is hinged on what I would describe as the chicken and egg conundrum. The chicken or the egg, which came first? Government is saying you are not paying tax and we can't do anything for you, or we can't do much. And citizens are saying you are not doing anything, so we can't pay tax. So it's a puzzle that may never be solved. So what is being done is to adopt, I like the word inclusive framework. I'm happy you touched on it when you were speaking. Because whatever we do from this side, OECD, you must always have that in mind. And what I mean is that you will need to put a lot more in practice in the days ahead to assist countries, governments in your policy plans and activities to ensure that this tax culture that is hinged on what I've just described is progressively heightened. Otherwise, we are going to continue to run into this problem. And the last point I want to make is that because of this tax culture problem, now it weaves into the consciousness of everybody. And what you find is that the policeman you are sending to go and catch the tax avoider or evader is himself, in his consciousness, he doesn't even believe on what you're asking him to go and do, because it gets to a point that it becomes a culture. And that is why you find that only institutions are actually paying tax. And even if they are paying, are they paying the correct rates, standard measures, and so on? So what I'm saying, therefore, is that it has a spiraling effect. So unless we get to a point, in Nigeria today, virtually all the 36 state governments, one way or the other, have adverts on radios, television, and other channels, media, encouraging citizens to pay tax, particularly with the onset of the oil crash and all that. Now, these are part of the activities that we believe that over time will get people to appreciate and to jump into this culture of, tax. So just to say that with this kind of paper on inclusive framework from the OECD perspective, I appreciate if this is given due cognizance. Thank you.
Very good.
I think all I can say is I agree entirely on that. I think there's a potentially interesting role for kind of aid effectiveness in terms of, as tax systems are changed, and that lag that you mentioned in terms of, the revenues actually producing some services. Is there a way you can integrate in terms of aid, in terms of allowing the services to come online at the same time as a new tax comes in, and then the aid tapers off as the tax comes through? And I think that's the kind of thing that should be thought about a bit more, and that might help to deal with some of those problems.
Can we have the microphone right down here in the front, please? Thank you very much, sir. It's your shout. I have everybody. I've seen your hands. Don't worry, I've got all the hands. There we are. Thank you so much.
My name is Dag Sorander. I'm in the Secretariat of the European Parliament's Development Committee. It's a fascinating process that you are describing, and a fairly broad one, although far from universal. And I wonder if you could say a few words about the non-participants and how you relate to them in terms of encouragement, possibly pressure, and how much the provisions that you agree upon are geared at dealing with the problems generated by the non-participation of a number of countries and jurisdictions.
Interesting.
Yeah, so I mean, there's, at the minute, I think most countries have been invited to join. There's some that haven't because they don't meet kind of any of the minimum kind of standards. I think that's right. And what has been said is that there will be countries that don't make any kind of commitment around these areas that are significant players in international tax issues. So so this is looking at not countries that have that are not interested in joining because they don't have the capacity to participate, but countries that are clearly playing a big role in international tax flows. There will be, I think, it's what's called a jurisdiction of interest. So all jurisdictions of interest have been invited to be part of it and commit to these standards. If those jurisdictions of interest don't, there will be some form of process to try and encourage them through various means to meet the standards that are necessary. That all remains to be worked out, and not least because the inclusive framework has only just started, and so therefore it needs to be given time to work out how it will take forward some of those. So the hope is that all countries that we need as the world to commit to this will, and you've seen some success in this around exchange of information. So, following the Panama Papers, Panama has now, for example, committed to automatic exchange of information, and so now it seems that all the major international banking centres have committed to exchanging information by 2018 at the latest. So we see that kind of process. So we're hoping that will work again. If it doesn't, it will be not for the OECD, but for the Inclusive Framework and its committees to work out how to go on that. And I'm sure the European Union, with its own kind of approaches to how it will deal with reluctant third countries, will be part of that dialogue in terms of seeing what the European Union has been successful with or not, and how that can feed through.
Thank you. The gentleman just here in the front. You're going to be the last one, so I've got three.
I'm referring once again to this Panama. If we go through the names that was revealed in the Panama Papers, we find a majority of them having shelters in so-called developed countries, especially dictators, tycoons who doorsteps, and then we wonder why this could not be handled at international level in respect of operation of such countries as Liechtenstein, Switzerland, and even Panama itself.
Interesting question. Do you want to take?
Yeah, I mean, it's a huge challenge for developing countries. I mean, it's estimated that somewhere around 30% of African assets are held offshore, and that's a huge loss of kind of capital for investment to start with, but also a huge potential lost tax revenue. There is increasing international efforts around this. It goes at the pace that countries will agree to, and that is, the politics is part of the problem. We do now have agreements around automatic exchange of information, of banking information. So, all accounts in details of who owns the accounts, how much money is in them, should be exchanged with the countries where those people are resident. And there's a challenge for developing countries because only a few developing countries are part of this process now. And so there's this again is a role for parliamentarians to ask questions of your government in terms of why are we not part of this process? Because very few developing countries are, and the reluctance to do this may in some way be linked to the people who have money offshore. I don't know, but there may be some conclusions you could draw from some of that. So I think there's, again, this is a role for parliamentarians to raise the issue and say, well, hang on, this, it appears that a lot of our country's cash is held offshore. What are you doing about this? There are tools available now, and many of your countries will be part of the global forum, but haven't kind of taken the next steps to say, well, we really want to make sure that we receive all of this information. So a good role, I think, there for parliamentarians to highlight these issues and not, and go beyond just say, the revelations in the Panama Papers are deplorable, but then really push that agenda in terms of, well, what are you doing about it? Here are the international tools, and by all means, get in touch with us at the Tax and Development Programme at the OECD. We'll tell you all the international tools that are available, and more than happy to provide you with as much information as you need to start asking those questions.
Excellent. The gentleman just here. I'm only going to have time just for you, sir, and then you afterwards. And that, I'm afraid that'll be it for anyone else. We won't have time. Sir, please fire away.
Thank you very much. David Goldsworthy from the UK National Audit Office. You mentioned in your presentation, Joseph, in a sense there's an asymmetry and it's quite a difficult task for parliaments to hold governments to account for the tax operations. One of the things that, of course, all countries have is their own supreme audit institution, which should be independent and should be there to support Parliament in its scrutiny work. To what extent has the OECD reached out or done any work with supreme audit institutions and the role that they might play in scrutinising the work that's being done on the audits of taxation? I think there's a lot of difficulties in many countries to actually do the kind of work that should be done. And there's a lot of capacity building, I think, probably needed there.
Keep the question.
Yeah. I'm going to show why I would never make a politician, because I don't know the answer to that question in terms of what the OECD's done. I'll try and find out, and I'll try and send the information to Adeline as well, so maybe we can get things sent around everyone.
The gentleman there, sir, you've got your hand up already. Thank you.
Thank you. My question is about, I don't know whether you have done any work, including tax exemption. What I mean here is that, especially what is in terms of loans given to most countries, come with exemptions from tax. In my parliament, this has been raised many concern about the level of tax exemption given to accompany these loans. And I don't know whether OECD has done any type of work or research in this area to know whether the level of exemption given to this is, in terms of loans and everything, is appropriate, and whether they are really one way short changing the government of those particular jurisdictions.
Interesting question.
Yes, so the toolkits that I mentioned, the first toolkit was around tax incentives, and tax incentives include tax exemptions. The economics is that generally tax incentives are a terrible way to encourage anything. If you want to do it, you should give grants rather than exemptions. But this toolkit exists, it's available online. I'll try and remember to send the link to Adeline and she can share it around. But yeah, it's something you can then ask your government to say, well, this toolkit exists. Has our government, used this toolkit or something like it to review our tax exemptions and tax incentives regime, and then hold them to account to it?
Can we have just a last question? Sir, I know you want to ask a question, but when I wind up, quickly ask Joseph on your way through, and then we can just right to the front. There we are. There we go. Thank you so much.
Thank you. A couple of questions, really, because I have an interest in this area. I was a tax consultant before I went to Parliament with PwC and so forth, but I also worked as a shadow finance minister in Kenya for some time dealing. I have a couple of questions. In terms of the the double taxation agreements that countries have used to kind of allow companies to pay tax in the area of in the country of their choice. What happens really in this context to those agreements? Would it be an end to that? For example, in Kenya, many of the companies would prefer. Some of the companies would prefer to register in a country like Mauritius, which has a better, taxation rates. Second, I think, is on the, are you planning to develop a legislation template for members of parliament, kind of to, similar to the anti-terrorism and, laws and what do you call it, the one on combating terrorism finance laws and anti-doping, and there are some international legal templates developed for countries then to, are you planning something along those lines so that it would be easier for members of parliament to do that? And lastly, on the multinationals, really, in terms of the shareholders, I mean, you have a company, a multinational company in UK, the shareholders are here, and you want to avoid profit shifting, you want the profits to be taxed in Kenya, and the shareholders will also have to pay tax. I mean, how are you going to address the legal aspects of the company's laws and so forth regarding, which would also have an impact on the taxes?
You have 2 minutes.
Okay. Okay, I've got 2 minutes to do this, so I shall try and quickly go through. Double taxation agreements. So one of the minimum standards is around treaty abuse, and so that is tightening the regulations to try and prevent the treaty shopping kind of approach. So the problem that Mauritius has caused, and so the intention is that there will be a multilateral instrument which is created, which will amend, which signatories to will effectively amend all their tax treaties in one go, and that it won't entirely solve all the problems because you still have issues around withholding tax rates and whatever, but it should prevent kind of the most egregious kind of treaty shopping stuff. So if Mauritius is being used as a conduit with no substance in Mauritius, it will sort that problem out. But if there's kind of some substance in Mauritius, then there may be further problems to come. But it's a step in that direction, and I think it will be for the inclusive framework to see how that works, and if further action is then needed once that's come in. On the legislation template, I don't know exactly. I suspect in the toolkits that are going to be gradually worked up in these areas, I imagine that in some cases there will be kind of legislation templates. I know in the Global Forum for some of the exchange of information stuff, they have done legislation templates. So So I would imagine we would see some legislation templates. It depends on the complexity of things and how well it's easy to have a template and how much things are very much domestic, will be governed by domestic circumstances. On the last issue, I mean, I think one of the reasons why we are trying to work through these things in situations like the inclusive framework is so that we have a forum to discuss these potential issues around, well, how do you address this across the whole spread of where a multinational is, and so experience can be shared and potential tensions discussed and addressed and enable solutions to be found. So I think these are not easy issues, but I think the inclusive framework offers a potential option. And I would be remiss if I don't say, if you are interested in knowing a bit more about how to get into the inclusive framework, there are some flyers here in both English and French.
We'll leave them on the table.
Yeah.
We'll leave them on the table. Okay. Could I please, on your behalf, thank Joseph for coming in this morning and giving us what I can describe as, even the bit I've seen, a highly comprehensive talk, and also answering the questions superbly. Joseph, thank you very much indeed. Absolutely first rate.
Thank you.
Excellent. Ladies and gentlemen, they always say for politicians, there's no rest for the wicked. So you're now going to be escorted by the CPA team back to the Attlee suite, which I think you're getting to know quite well. So thank you very much for joining us all here for breakfast this morning. Have an excellent day, and I will join you later. So thank you very much indeed for your questions, for your attendance. Thank you.